Okay, so how a bank manages assets and liabilities to earn the highest possible profit? First, we must do what? Match the assets with what? With liabilities. Okay. So the second item could be what? We must take care of deposit outflows. So deposit outflows and the risk that might arise because of this deposit outflows is also important to be monitored. So keep enough ready cash to pay to depositors all the time. And it means what? It means doing the liquidity management, okay? So the acquisition of sufficiently liquid assets with a high quality to meet the bank's obligations to depositors. So for this, we must have what? Asset management, okay? So the asset management is another item. To be considered means make a balance between risk and diversifying of asset holdings. So we must have liability management also. So the final one maybe is the liability management, acquire funds at low cost. Okay, so the risk management is also important that can be mentioned here. So we have the situation that we have no risk, but we might lose the opportunities. So maybe we have no risk, but the opportunity loss might happen, okay? And for deposit outflows, we have risk, of course, to the bank because of the deposit outflows, but for the first one, we might lose some opportunities that is also important to be into consideration. So for these kind of things and for asset management, for liability management, we can consider the assets of the bank, and we have to also consider the liabilities, right? So if we consider, for example, the assets of the bank in different buckets, for example, let's say 1 to 90 days, 91 to 180, 180 to 270, 271 to 365 days, and finally we can consider the over 1 year, okay, and let's say we have these different categories, and in different buckets. And finally here, the total. So here, these are all days, days, days. And here we can have what? We can have in the asset side, we can have the cash balance, we can have the bank balance, we can have the investments. That is a kind of asset for the bank. We can have the interbank lending that will make the interest rate income for bank, and that is a kind of asset also, lending. And also the loans that is delivered to the customers or enterprises, so the loans and advances, right? So these are the assets that we might have. And they will give us what? They will give us the cash, what? Inflow, right? But we have also the cash outflow. So the cash outflow that might be here from the liability part. That the liabilities could be what? The interbank, instead of lending, borrowing. So interbank borrowing. We can mention the deposits, okay? So the deposits are a kind of liability for bank deposit. We have the current deposit, we have the saving deposit, so saving one also can be mentioned here. We have the fixed deposit, for example, so fixed one can be also mentioned here, and the other kind of deposits that we might have. So the others and here. So these are the cash outflows and these are the cash inflows, and we have the different buckets that we have to consider. So if we have a liquidity gap from what we're going happening here in different buckets, so we might have here the liquidity gap, okay, that we call the LG. So this liquidity gap can make what? The liquidity risk, okay? So the result is the liquidity risk that we have to consider, and this liquidity gap could be negative, okay? So if it is negative, then we have what? The future fund raising is required, and if it is positive, the future investment is required. Okay? So we can have the positive gap, we can have the negative gap, so the situation for each would be different. Okay, so if we have a need here and surplus here, so maybe this gap is positive, maybe this one is smaller than this one. So it would be a negative gap, right? And when we have this kind of gaps, we have risk, right? So we have risk to the bank, and this risk to the bank might give us what? The deposit outflow. Okay? So might be something like this, okay? Break in the amount of money that we have. In the bank, and the flow of money outside, that it would be the cash outflow or the deposit outflows, and it will make what? It will make a problem for the bank because of the deposit outflows and liquidity risk that might arise based on the request of the customers for the money and withdrawal of the money from the banks in a very huge amounts because of the panic, right? So this is the risk that we might take, and these are important to be managed. And because of this risk and because of all these possibilities, we have to keep some amount of money untouched in Tajin bank that we can use it at the time of the stress, okay? So we have the capital adequacy ratio, for example, that is what? Based on whatever the risk that might be there. So the risk weighted assets, we must have enough capital plus tier 2 capital, so the capital that we have in the balance sheet should be able to cover the risk that might arise from all the activities or all the things that are important to be managed in the bank. And finally, capital adequacy management is important. The capital adequacy management, which is the amount of capital the bank should maintain and then acquire the needed capital at the time that we need the liquidity or we have to deal with the kind of risk that is arise. So when we have this liquidity gap and the liquidity risk, we have to somehow manage it with the people that they are in the board. of directors or by the people that they are already in the asset liability committee. So this committee from the asset liability they have to manage it, or if it is necessary, maybe they want to do what? In very severe situation, they might need to have a decision from the board of directors of the bank. To do what? To maybe raise funds from external sources. So that would be injected here to solve the problem of the liquidity gap. Or they might need make some asset liquid falling under next bucket. So if we have an asset here, maybe we need to liquid the asset, okay, to solve the problem from the short-term buckets that we have here, okay. So this needs the decision by the asset liability committee to make all these transactions safe and the quality of the assets and the liability by considering all of these items that we have here. And in the case of necessity, we have to ask the board of directors to make a decision about something that might be a little bit more serious. Okay? So about the liquidity management, and the rule of reserves. We might have the deposit outflows occur when depositors do what? Withdraw cash from checking or saving accounts or write checks that are deposited in other banks. So suppose that the bank is required to keep 10% of its time and checkable deposit as reserve. So basically we have this 10%, okay, of the time and deposits. So the initial balance sheet should be considered as this. the asset side and the liabilities. And here we have what? We have on the asset side, we have the reserves, let's say 20 million euros, okay? And we have loans, let's say 80 million, and securities as the asset, okay? So 10 million again for securities. On the liability side, we can have what? The deposits. Let's say 100 million. And we have the bank capital, let's say 10 million. Okay, so 10 million for the bank capital, and this is the asset and liability sides of this balance sheet, 110 and 110. So the banks required reserves 10%, as we said. The 10% of the 100 million means what? That 10%. It's a 10 million, okay? So it would be 110%. 10 million. Since it holds 20 million here as the reserve, the first bank, this bank, has accessed the reserves of how much? The 10 million, okay? So 10 million minus this 20, so it would be 20 minus 10. And if a deposit outflow of 10 million occurs, the bank's balance sheet becomes like this. The asset side and the liability side again. So we have the reserves again here. The reserves would be this 10 million. We would have the loans untouched, so 8 million, and the securities similar, 10, okay? So this is the asset side. The liability also is the deposits. The deposits are reduced by this 10 million, so it would be 90 million. And the bank capital is untouched, so 10 million here. So the bank loses 10 million of deposit and 10 million of reserves, and its required reserves are now 10% of only 90 million that we have here. It means that 9 million, okay, so 9 million, that is less than 10 million that we have here, okay? So it is 1 million less of the reserve that we have in the balance sheet still, and the situation of the bank is good. But imagine that the situation not be like this. We have the assets here, the liability here, and the bank holds insufficient excess reserves. So the reserves, let's say, is 10 million, the loans 80 million, and the securities again 10 million, okay? So the deposits again 90 million, and the bank capital 10 million. So when it suffers the 10 million deposit outflows, what will happen will be the situation, the reserves, because of the 10 million deposit outflows, would be 0, okay? The loans would be what? We have the 10 million outflows and 90 million for the loans and the securities 10 million. For deposit we have 90 million and the bank capital is 10 million. So the bank has a problem because there is no reserve here. So to solve the problem, bank can borrow the reserve from other banks or corporations with interest rates on this borrowing, that is high interest rate. And if it borrows like that, the reserves would be what? It can have the reserve from that needed amount of money, that is 9 million. And the loans would be 90 million, securities 10 million. This is on the asset side. On the liability side, we would have what? The deposits 90 million, okay? But now we have the borrowing from other banks, that is this amount, that is now as the reserve, so 9 million here, and the bank capital is also how much? The 10 million, similar to what we had before, okay? So that is another way to solve the problem, to have the enough reserve. Now we have the 9 million reserve, but we have to pay the interest rate, and we can also sell some of the securities to provide enough reserve in the balance sheet, but it has also the transaction cost that should be also considered, but that is another way to solve the problem, by selling some securities. So in the asset side, the reserve would be 9 million as we need. The loans untouched, the 90 millions. And the securities now might be less because we had 10 million securities. Now we need to have the reserve for 9 million. So the securities would be 1 million. Okay? And the deposits here will remain 90 million, and the bank capital, as we had before, 10 million. So these are the ways that we can have the enough reserve to have the liquidity management and enough reserve for the regulations, based on the regulations or based on the outflow that we have in the bank and we might expect from whatever it might happen for the bank. So it can borrow from the central bank also, so as a last resort for the money, the central bank or interbank lending market could be also used. So if we use this source of money, then what might happen? We will ask money from central banks, so the reserve again that 9 million, the loan 90 million, the securities 10 million. But on the liability side, we have the deposits, that is 90 million, but we have the loans, right? So we have the discount loan from central bank, for example. So that is 9 million here. And the bank capital, that was 10 million, okay? So finally, bank can have this 9 million of reserve to meet the deposit outflows by reducing the loans or depositing 9 million in central bank, which will increase its reserves by 9 million that is needed. But it is also very expensive, right? And another expensive way is reducing the amount of the loans. So the loans that we had on the asset side, this part, and then charge this part as the asset and liability. So we have the reserves. We need the 9 million here. So the loans could be reduced from 90 to 81 million to have this 9 million as a reserve, and securities would be untouched. The deposit would be untouched, and the bank capital 10 million untouched. So it is also very expensive for the bank to reduce the loans by selling them off or to other banks or the financial institutions. Why expensive? Because the new banks, they don't know really the customers, and they do not personally know them, and they will consider them as the higher risk customers for higher cost, and much more than full value will be requested to buy this kind of loans from the another bank. So we have the solution of central bank, okay, to deal with this kind of problems. And also to get the help of the other banks. So some amount of money may be requested but all of these sources of money, they are expensive and they cost something, right? So that is not very easy to do that. We have to consider a high payment and high cost to deal with this kind of shortcoming from the reserve part, okay?